Good morning, June 10th, 2022. We just had the CPI index come out, a bit inflated, excuse the pun. And I thought it was probably a good time for us to chat a little bit. So I'm presenting this sort of market conditions flash to help you guys get through the weekend. So stand by while I share the screen and we will get to it. Here we are. So, okay. All right, so where are we? What's our take? Okay, at ALINE Wealth, we always try to have a deep understanding on what's happening in the markets and the economy. So we have our take. It's a fluid process. We go through it, we discuss it amongst the committee here at ALINE. We have other folks that ring in and we tap them for their information and their takes as well. And then we coalesce it into our take. Essentially, is a regime change. We've had 40 plus years of a bond market that is buoyed by ever lower interest rates, going lower and lower, right? From, back in 82, we were what, 15, 16, 17%, maybe even hit higher than that. And then we went down to zero. So you see this huge bond market rally over the last 40 years. And that spawned, at least the low inflation was spawned by the increasing power of the emerging markets, China and others on the world stage. Of course, technical innovation, technology was also part of the slowing of inflation. And because of that slowing of inflation, interest rates have obviously come down a lot, and relatively tranquil geopolitics over the last 40 years. And because we've had our issues, but nothing like I think we're having today. But we've had some issues, clearly, but somewhat tranquil. And I'll call it an apologetic Fed, which means essentially they just the Fed put, right? They had our back. And this was the 40 years. And now there's a new sheriff in town. And something has changed. What's changed is that we've now increased inflation to a point where interest rates have to be increased. And because of companies looking at supply chains more nationalized, because of the fact that we have the situation in the awful war and the terrible loss of lives, and of course the economic implications there as well. That's obviously, let's hope that's more short term, but we don't know. The bottom line is that elements have changed. And this is not, and so we want to make sure we understand that this is not just a market reaction that's short term, it may be longer term. However, where changes occur or when changes occur, there can be great opportunities as well. And so there's been some pain. There's no doubt there's been pain, but that areas of pain for the most part have been focused on highly leveraged sectors and companies and those with most stretched multiples on sales even. So we've talked about these hubris stocks in the past, and for the most part we've avoided them, for the entire part we've avoided them. So that's good. Okay, so some internals. This is a great slide, guys, that I want to bring to you from JP Morgan that speaks to consumer confidence, which just came out this morning at a new low. Typically, when we see these lows in consumer confidence, we've seen in the past markets go higher after hitting those lows. So again, we don't know what the low in consumer confidence is, but obviously, the headlines are such that are clearly causing some concern by consumers, rightfully so. You've got a war going on, you've got inflation everywhere. You could see these things, the market's going down. So it's not surprising to us that we're seeing consumers less confident. But the good news is that is a bottoming or start of a bottoming process. We're not calling a bottom here. No one calls bottoms, right? That's a process. The process is you've got cash on the side. We've done that early. Remember, we were early on this inflation call last year. So we've been keeping that dry powder available to put to work on down days and when things get really bloody. And that is the part of that bottoming process. This is a statistic that lends to that. that as we see consumer confidence coming down, typically going forward, we have a better market. So that's a good thing. Stay tuned to that. This is a quantitative measure from our friends at FactSet. And what we look at here is each of the sectors of the S&P, and this is the S&P in itself, and how their forward PE, and I put an asterisk on forward because that's expected earnings next year. So we really don't know what those earnings will be, right? So they could be lower, therefore making these PEs higher. The point is that we are in many sectors very close, and in some cases lower, much lower than our 5 and 10-year historical average. So, what you want to say to yourself, okay, financials typically trade in the last 5 and 10 years at 13 and 12.9x forward earnings, and now they're trading at 12. So maybe that's saying, well, interest rates are higher. Well, that's kind of good for financials, though. But maybe they're saying that, perhaps their earnings aren't going to be as good. I don't know. I mean, I kind of think financials are attractive. So you could see where we're trading relative to historic averages of forward PEs. This gives me some comfort that we're getting, again, to that level where one could say, I'm kind of feeling better about the numbers. Then we have this, which from our friends at Strategas, that show our PE, the next 12-month, again, forward PE ratio, and how, wow, it's come down, man. It's really contracted. But there's some potential more pain ahead. Just historically, we've seen in big bear markets, think 2000, 2002, 2008, 9, we don't really see a bottom until we get to that like single digit-ish, 9, 10, 11-ish number on PE. And that will give us some sense of, getting towards that bottom. That might be more on a trailing side than a forward side, but I think, in this sort of zone here, we could expect, maybe getting closer to that bottoming process. So it takes some time. But make no mistake that this come down, this contraction in PE provides us with the opportunity going forward to be buying at reduced levels. And that's the idea. Again, we're not looking, we can't call a bottom. We're going through the process in finding a bottom, slowly, carefully. Small caps. Now, here's another situation where you see the forward PE. We're talking about 20-year lows. I mean, it's down to where it was back, here, I guess, when in 08. So that's a huge downhill. So I guess what I'm trying to say here is that we're at levels here that would be consistent with the lows in March of 09. That gets me interested, right? Because now I'm saying, well, I'm buying really, at a low level. Not to say it's a bell that goes off and you say instantly, hey, now's the time to buy. Again, it's part of the process, one of the elements that we put in to our understanding to get us to, figure out when or what we should be positioning it for our clients. The disclosure statement is here. Want to thank you for your time and attention today. I know these markets are difficult and scary, and we understand that at Align Wealth. We're here to make you feel more comfortable, to go over your financial plan, to review your cash flow plan, to review your portfolio. But make no mistake, we are engaged and active and monitoring the portfolios that we manage very carefully. And we also believe their opportunities will be available to us. So, as you know, we've identified a few different sectors that we are excited about and are happy to discuss that with you at any time. Thank you for your attention. Have a great weekend, and look forward to chatting with you again soon. Peter Klein, Align Wealth. Take care.